still a forward-looking mechanism, right? So it hasn't happened yet, but the probability is it's going to happen and going to happen sometime soon. So it has certainly supported asset prices.
Yeah, and it depends. Question is how it happens. Part of it, some of it. I think both the Democrats and the Republicans in Congress agree, Kevin, that repatriation. They all agree on, lowering corporate taxes, which are the second highest in the world next to Japan, and also having foreign corporations repatriate, give them incentives to repatriate that money to the U.S.
Right. The talk is of some sort of special tax on repatriated funds as corporations bring it back to the U.S., maybe as low as 10 or 15%. The thought is that would enable a lot of corporations to then invest here in the U.S. as opposed to keeping that money abroad and investing it abroad.
Yeah. So again, what's being considered is doubling your standard deduction from $12,000 to $24,000. Those without mortgage, you may take the standard deduction versus taking the deductions. 3 tax brackets, 12, 25, 35, again, but wasn't outlined at what point you hit those tax brackets, and repeal of personal exemptions, and increases of the child tax credit, and repealing AMT, and eliminating most, this is where New Jersey, New York, Connecticut, Massachusetts, and California would get very hurt. It would eliminate the itemized deductions, which means property taxes and state income taxes would not be deductible.
Although that's very, as you know, very controversial. It just seems like there are enough Republicans from high tax states that might not be favorably disposed to that it might be very difficult to pass that. Yeah,
so it's, when we look at that from a tax cut standpoint, who knows what it's going to look like when it comes through Congress, and, there's never a guarantee that it does come through Congress, but we're hopeful that something from a corporate side and from an individual side that they can agree on something to, have that move forward. And again, reduce this corporate tax rate to 20%, but what most people don't realize now it's worldwide income. So, it may not be a, and again, corporations, all the details we need to, look at all of them. And, when you think about it, Apple has $1/3 of $1 trillion overseas. That's a very considerable amount of money. And then you throw in the big pharmas that have money overseas, and the other tech companies, Microsoft, I saw something was over $100 billion, well over $100 billion. Google, I'm sure, is up there, over $50 billion. So having that money repatriate, as long as they spend it, will be a stimulus. So again, we'll wait and see and keep you aware of what's happening as it moves forward. In terms of the S&P, this is a real big debate. I was in our Milburn office on Monday all day, and I had CNBC on the TV in there, and all day long is basically the conversation was about valuation. So there's so many ways to look at valuation. Is the market undervalued, overvalued, and how long will it be overvalued? I mean, we as a team speak about that, and Kevin, why don't you talk about which Alan Greenspan, I won't say created in terms of one level of looking at
yes, you remember his famous rational exuberance comment. Of course, I think that was 1996 that he said that, and the market just powered ahead for several more years, but ultimately, of course, it did correct after the internet bubble popped. Our view on this is that based on forward PE, the market is certainly above its average. Whether you're talking about a 100 or plus year average or even a 25-year average, it's slightly above it. The forward PE for the S&P 500, which basically takes the current price and divides by the consensus earnings estimates, is right now at about 17.7. The 25-year average for that number is 16. So, yeah, it is a little bit above average. On the other hand, where are you going to put your money? Bond rates, bond yields are quite low, so the prospective return on bonds is not very attractive, and if you compare the yield on stocks to bonds, it's makes stocks look more attractive and a better value.
Yeah, and again, when you look at equities, you better make sure you have the right allocation because, I met one of the lead people at MIT's economics department. He predicted the financial crisis, but he predicted it in '01. And I reminded him I bought my house in '01 and never went below the value of '01. So timing is everything. So from a perception standpoint, the key is to having the right allocation, right, John?
Right, and look, if we're in expansion as part of the cycle, it's not unusual for PE ratios to be higher than average. It's actually typical and normal, and PE ratios could be higher than average for a persistently long period of time. So I think it's really prudent to be thinking about valuation in terms of one indicator of what future market performance can be, but there are several other indicators that are certainly not flashing red. So in other words, fundamentals are very strong. Growth has been solid. There's really no other indication other than valuation that would suggest that there's any type of a pullback coming anytime soon.
And the Fed, the headwinds possibly for the market this next quarter could be the Fed, depending upon, most people are expecting one increase this next quarter in December. So it's, and most likely 0.25%.
Right.
So,
I saw on Bloomberg this morning that the Fed funds futures is pricing in about an 80% probability of a 0.25% hike in December.
And also the economic numbers have been strong, so I think. But the challenge with the Fed is with raising rates is economic numbers have been strong, but we really don't have inflation per the Fed. Those of you out there, I know our healthcare in the past 2 years for our company has gone up well over 30%, in terms of premiums. So that's inflationary. Food costs are inflationary. Airline costs are inflationary. Vacations are inflationary from speaking to our clients and various vacations. So it really depends, where your budget is being spent, whether you're feeling it, the impact of inflation or not. But employment has been solid. Clients' children, most of them have graduated last quarter, and this is feedback from them. Most of them, a very, very high percentage, have jobs and good paying jobs. So, I'm pretty optimistic on the U.S. economy. And we were talking recently, Kevin, about the manufacturing numbers, and they were very positive.
Right. The Purchasing Managers Index of manufacturers is the highest it's been since 2003, like 13, 14 years. So it's quite high, indicating that the economy is growing strongly. In fact, if taken just on the face of it, that number by itself historically would have indicated a GDP growth rate in excess of 3%.
Yeah, and part of it is, believe it or not, a lot of foreign companies are manufacturing in the U.S. Apple's largest supplier is building a plant in, if I remember correctly, in the desert of Arizona, and is going to employ, off the bat, 2,000 employees and could increase over time. And you think about down south, all the major car manufacturers have plants in the U.S. Every one of them have plants in the U.S. And recently the largest, a few weeks after the hurricane in Houston, Exxon opened up the largest plant ever in the U.S. in terms of refining oil. In terms of capacity, probably close to half of what all the other ones have combined. So it's going to be interesting as we move forward. But the economy is on solid ground, and honestly, the U.S. is the best game in town. And again, we talked about interest rates before. We don't believe interest rates are going to go up dramatically in the next year, but they're going to move up just because from economic growth and what the government's doing in terms of with their balance sheet. But again, John and Kevin, last quarter we made change, or actually end of the year, after the election, we made changes positioning a portfolio for an increasing interest rate environment.
Yeah, we became a bit more defensive, lowered our duration. Duration, of course, is a measure of interest rate sensitivity. And as interest rates go up, of course, bond prices will go down. And so we wanted to be more defensive and guard against that, not be as subject to that kind of price adjustment in the face of interest rates moving up.
Well, right. I mean, look, at the end of the day, the Federal Reserve back in 2008, 2009, used quantitative easing as a tool in order to artificially hold longer-term rates down persistently well below what historical averages for longer-term rates had been for quite some time. So it's about 10 years now that we've been well below average. If rates were just to climb back to normal, which I would anticipate we should see over the course of the next 3 or 4 years, then the 10-year Treasury, which is trading around 2.3%, would probably be trading above north of 3, closer to 4%. So it is prudent to be more defensive in the bond market from the standpoint of duration.
Especially now with the Fed this month has announced that it is going to be unwinding its quantitative easing in terms of allowing its big book of treasuries and mortgage-backed securities to, over time, slowly decrease. And, of course, that's essentially reversing course, as you say, from what they did in the quantitative easing. The idea was to push interest rates down. You got to believe that if they're reversing course and letting the book decline slowly over time, that will have the opposite effect, potentially.
But we also have to consider world events, and we have to consider the expanding emerging market economies who are buying our debt now, where before they weren't buying our debt. So it may not have as big of an impact. It's not going to, it's not going to be a huge spike in interest rates. But over time, they will drift up. And the government has control over, in terms of how the market can handle them, in terms of moving bonds off the balance sheet. They have the ability to not do so for a couple of quarters. So, the Fed's in pretty good control in terms of what they're doing. And Janet Yellen, as long as she continues, is very aware, and the Fed will make sure that the balance sheet is handled as best as they can. So yeah, I mean, this is just talking in terms of one of the slides about, in terms of moving it off the balance sheets. U.S. and international equities, in terms of, the P/E ratio really is, on the international side, really hasn't, as I stated, most of the gain has come from currency. So from a P/E standpoint, it's pretty similar. It really hasn't moved up like the U.S. markets have moved up from a P/E ratio standpoint. But the foreign markets have continued to heal, their economies, and Italy, Spain, Greece. I mean, trust me, they're not dynamic, forward-moving economies, but they're getting better over time. That old saying, time heals all. What we did in terms of in the past quarter is, on the international side, John, why don't you talk about some changes that we made in the portfolio?
Yeah, I mean, generally speaking, what we've done is we've added some dollars to emerging markets at the expense of developed markets. So typically, we have about a 75% weighting in developed markets, which would be, Europe, Japan.
Developed foreign markets.
Correct. And we moved that allocation over toward more of a 60-40 allocation. And I'd say there's, a few different reasons for that. One of the things that I know we talked at length about in our investment committee was about the potential of seeing some inflation moving forward, and that the emerging markets are a good proxy for materials and energy and different areas of the market that would benefit if we did see inflation normalize.
Right.
Because they sell so much of those.
Yeah, and most of the emerging markets are commodities based. And this past quarter really isn't an indication about energy prices because of the storms that we had in the Atlantic has impacted the price of energy. We'll see where they normalize in the next 6 months in terms of energy prices spike because of the what happened with the hurricane hitting Houston, which obviously is and that whole region, they're huge producers of energy. So we'll see what happens from a pricing standpoint. But normally, as the world expands, energy prices and commodities will move up, and emerging markets should benefit from that, as you're saying.
Mm-hmm. Another reason, you said there were several reasons. Another major reason for being positive on emerging markets has to do with sort of more of a long-term portfolio effect, in that emerging markets tend to have a lower correlation with the U.S. They tend not to move up and down quite so much in lockstep as, say, as developed markets do, which tend to be very much similar to U.S. markets. So we get some diversification, lowers the overall risk.
Right, and we talked a little bit about price to earnings multiples as well, and from a valuation standpoint, emerging markets on a pricing basis have been probably a little bit more reasonably priced than they had been historically as well.
Exactly. Third reason.
Yeah. But again, we don't have a huge allocation to emerging markets because the volatility that can be in that asset class. The U.S. markets may have dropped more than 50% during the financial crisis. Emerging markets, most of them dropped more than 80%. So that's a concern. We don't want to place a bet, but we're tactically making changes to increase our emerging market exposure, but we're using international and not from the U.S. in terms of to moderate risk and, again, keep the balance appropriately for clients.
Right. I mean, I'd say an average portfolio is at Prestige probably has, even with an increase to emerging, less than probably 4% of the overall portfolio in emerging markets.
And we bought at a great time, with some of those moves. So it's all about diversification. In terms of earnings, you're seeing pretty much earnings pick up across the board. Now, another thing in terms of U.S. valuations, with the dollar, being weaker, a lot of U.S. companies have benefited, multinational companies benefited from that in helping their earnings because now their overseas revenue, if they had $1 billion of revenue now, and it's $250 a quarter, now last quarter their revenue ticked up, over 11-12% because of currency fluctuations, which benefits profitability of multinational companies, right?
Absolutely.
But we also have to keep in mind they manufacture overseas, so it depends upon how much manufacturing is done. Their expenses are going up also.
Yeah.
So, from a valuation standpoint, outside of the U.S., but again, when you buy a big car, you pay more. And the U.S. is the best economy in the world overall. So that's why in terms of valuations, but again, overseas is, from a historical basis, is
Right.
Right, right.
You could see in the chart that both Europe and emerging markets, from a price-to-earnings standpoint, they're reasonably priced.
And again, the central bank, global central bank, in terms of their monetary policy, is going to shift also as the economies, continue to recover, over time. Just as the U.S. balance sheet, what we're doing with the U.S. balance sheet. It's always, diversification, asset allocation. You need to, bonds aren't going to perform in line with equities, but when equities don't perform, again, bonds will give you the balance in the portfolio to support your retirement and your goals. In terms of, when I look at 1 year in my career in the 1990s, the best performing stock was Microsoft, by far. The largest seller of Microsoft that year was Bill Gates.
Right.
And he bought $1 billion of U.S. Treasuries. He was the largest individual buyer of U.S. Treasuries. Again, diversification. And if he would have left that billion in, it probably would have been worth $8 or $9 billion today. That billion he diversified. So diversification always makes sense within a portfolio, especially as planning for retirement. Rebalancing. We'll look at year-end at rebalancing opportunities. This year so far, value stocks have underperformed. Last year, value stocks outperformed. So we'll be looking at rebalancing opportunities at year-end. And liquidity, you got to make sure from a liquidity standpoint, a large sum of money, that even though I was talking to a very good friend of mine of 30 years, and his son's 2 years away from college, and unbeknownst to me, he moved his 529 plan to be 100% equities. And in my conversation, that's not appropriate, and he's going to make changes, and I explained why. Because the liquidity need 2 years from now, 2.5 years from now, he's starting college. So that's totally inappropriate. So again, you always have to consider liquidity, and again, diversification helps from a risk exposure standpoint. So I want to thank everybody for their time today in the market update. And again, we look forward to continuing, and I'm going to hand it over.
Right. Once again, thank you for joining us on this webcast. I apologize for any technical difficulties that we had. We look forward to continuing our series of these calls with you in the future. We really do appreciate your feedback, so please feel free to send us an email with your comments or questions to pwm@prestigewmg.com. We hope to see all of you at our upcoming Retirement Lifestyle Symposium on Wednesday, November 8th at Maggiano's in Bridgewater. If you haven't already done so, please email or call me directly to sign up. You can reach me on my direct line at 908-583-8603, or my email is candre@prestigewmg.com. From all of us at Prestige, please enjoy the rest of your day. Thank you.
Thank you.